For decades, silver has existed in the shadow of louder markets, quietly absorbing stress that never fully shows up in price charts, and that silence is starting to break in ways that are making institutions uneasy, because the recent highs don't look like speculative noise so much as unresolved pressure finally surfacing. Historically, when silver moves late and then moves fast, it's not responding to headlines, but to imbalances that have already hardened beneath the surface, and the current price behavior suggests something structural is being tested rather than traded, raising questions about what has been holding it down for so long. Behind closed doors, large participants don't talk about silver as a metal at all. They talk about it as a constraint, a bottleneck that touches energy systems, electronics, defense supply chains, and monetary hedging all at once. And that overlapping role is why the recent highs are being treated less like a rally and more like a signal. At the institutional level, there's a growing discomfort with how little margin for error remains in the physical market, because paper liquidity still looks deep, while deliverable supply appears increasingly inflexible, and that gap only matters when something forces it into the open. On trading desks, the conversation has shifted from whether silver can break higher to what happens if it does so without the usual participation from retail flows, since that absence would suggest the move isn't being driven by enthusiasm, but by necessity. In that context, the new highs don't feel like an endpoint. They feel like a boundary being pressed from multiple directions at once. And the question now isn't whether silver is expensive, but what breaks if it isn't allowed to reprice further. For much of the past cycle, silver's price has been managed through expectations rather than scarcity, with futures curves and options markets absorbing pressure that would otherwise force immediate repricing, and that system only works as long as confidence remains intact. In recent months, available data suggests that confidence is thinning, not collapsing, but thinning enough that routine hedging activity is starting to behave defensively rather than opportunistically, which is rarely visible to the public until after price has already moved. What's changed isn't demand in isolation, but the timing of it, because industrial buyers appear less willing to delay procurement when prices dip, implying they no longer trust softness to last. And that subtle shift can drain inventories faster than any headline-driven surge. At the same time, market behavior implies that traditional short-side pressure is becoming more selective, with positions rolling forward instead of expanding, a pattern that usually reflects caution rather than conviction. In the U.S., where silver straddles both commodity and monetary narratives, policy uncertainty has made long-duration hedges less fashionable, quietly increasing the appeal of assets that don't depend on counterparty performance, even if they remain volatile in the short term. What makes this moment unusual is how little public commentary has accompanied the move, because when silver rises without explanation, it often means the explanation hasn't become safe to say out loud yet. That silence leaves an open question hanging over the market, whether these highs are being tolerated as a release valve, or whether they're the early stages of a repricing that no one wants to be seen endorsing. For years, the physical silver market has operated on the assumption that supply tightness could always be resolved with time, substitutions, or financial engineering, and that assumption is now being tested by overlapping constraints that don't respond to price signals in predictable ways. Mining output has been slow to adjust, not because of a lack of interest, but because silver is often a byproduct, leaving supply decisions tied to other metals' economics, and that structural lag becomes problematic when demand accelerates on its own timeline. Refining and fabrication add another layer of friction, as capacity expansions tend to trail demand rather than anticipate it, meaning any sustained increase in orders pulls material forward from future availability, quietly shrinking buffers that markets assume still exist. In the United States, strategic stockpiles are rarely discussed in detail, but procurement patterns suggest a preference for reliability over cost, especially where silver intersects with defense, energy infrastructure, and advanced manufacturing, and those buyers don't step aside when prices rise. What's notable is how little elasticity remains once these channels are engaged, because industrial demand doesn't behave like investment demand. It doesn't wait for pullbacks or technical confirmation. As more of the market becomes price insensitive, the burden of adjustment shifts to the remaining float, which is smaller than most models assume, and that's when volatility stops being random. The current highs may still look orderly, but underneath them is a market discovering that flexibility it relied on for decades might already be spent. For institutional risk teams, the concern isn't the level of silver's price. It's the speed at which assumptions are being invalidated, because models built on abundance behave poorly when even small shortages persist longer than expected. In derivatives markets, liquidity still appears ample, but the character of that liquidity is changing, with fewer participants willing to warehouse risk for extended periods, and that reluctance quietly transfers stress back to spot pricing. Clearing mechanisms were designed for volatility, not for sustained directional pressure tied to physical constraints, and when those systems are asked to bridge the gap too often, they start to reveal where confidence is doing more work than collateral. What's emerging is a subtle divergence between financial silver and usable silver, a distinction that matters little until it suddenly matters a great deal, especially for entities that can't settle in cash and move on. In the U.S. market, where trust and settlement has historically been taken for granted, even minor delays or sourcing complications tend to ripple outward, altering behavior before any official acknowledgement occurs. Those ripples don't show up as panic. They show up as caution, tighter terms, shorter horizons, and a growing preference for certainty over optimization. Once that mindset takes hold, price stops being the primary signal, and availability takes its place, which is when markets tend to move ahead of narratives rather than in response to them. As silver pushes into unfamiliar territory, comparisons to past cycles are resurfacing, but they're being made quietly because the parallels aren't comforting and the differences are harder to model. In prior episodes, silver's breakouts were accompanied by visible enthusiasm, inflows, and public debate, whereas this time the move has unfolded with restrained participation, suggesting that the drivers may be less about belief and more about obligation. Reports indicate that some long-term holders are reducing willingness to lease or lend metal, not as a statement but as a precaution, and when passive supply steps back, even temporarily, it changes the rhythm of the market. That retreat places additional strain on intermediaries who rely on continuous circulation to keep prices orderly, and their response has been to shorten exposure rather than expand it, a defensive posture that rarely attracts attention until it becomes widespread. In the U.S., where financial markets are accustomed to depth and flexibility, the idea that a commodity market could become constrained feels abstract, yet behavior suggests participants are preparing for precisely that possibility without saying so explicitly. This preparation doesn't manifest as hoarding or headlines, it manifests as fewer promises, narrower commitments, and a subtle shift towards self-reliance. When enough actors make that shift at the same time, the market doesn't break, it tightens, and that tightening has a way of revealing pressures that price alone can't contain. At this stage, attention is turning toward the mechanisms that have historically capped silver's advances, not because they've failed, but because they may be losing efficiency under current conditions. Price suppression narratives tend to oversimplify what is usually a network of incentives, hedges, and risk transfers that function smoothly until volume, timing, or delivery requirements shift just enough to strain them. What's different now is the layering of demand sources that don't coordinate with one another, industrial, strategic, and financial interests, all drawing from the same pool without a shared tolerance for delay. In the U.S., regulatory frameworks prioritize market stability, but they're not designed to manufacture supply. And when interventions focus on smoothing volatility rather than addressing constraints, the effect can be temporary. Market behavior implies that some participants are testing boundaries, probing how much stress can be absorbed without triggering visible responses, and those tests rarely occur unless the testers believe conditions have changed. The absence of sharp countermoves suggests either confidence that the system can hold or uncertainty about how to respond without escalating the situation. That ambiguity leaves silver in a narrow corridor, where small shifts in behavior could have outsized effects, and where the next move may be less controlled than the last. As this corridor narrows, the question facing institutions isn't whether silver can move higher, but whether the market infrastructure can accommodate that move without revealing stress points it has long kept hidden. Payment, settlement, and inventory reporting systems were built for efficiency, not scrutiny, and when conditions tighten, transparency doesn't increase, it fragments, leaving participants to rely on partial signals and inference. In the U.S., where confidence in market plumbing underpins everything from pensions to procurement contracts, even the perception of strain can alter behavior faster than any formal change in rules. Some participants appear to be shortening feedback loops, reducing the distance between decision and execution, which is a rational response when future availability becomes harder to forecast. That compression of time increases sensitivity to small disruptions, whether logistical, regulatory, or geopolitical, and silver's global footprint means those disruptions don't need to originate domestically to have domestic effects. What's unsettling is how little room remains for miscalculation, because when buffers are thin, errors don't dissipate, they compound, often surfacing in places far removed from their source. The market hasn't reached that point, but the path toward it is becoming clearer, and once seen, it's difficult for experienced participants to ignore. As silver approaches this inflection, the focus shifts from charts and forecasts to behavior under constraint, because that's where markets reveal their true priorities. In the U.S., policy responses tend to follow visibility rather than anticipation, and silver's challenge is that its stress accumulates quietly, only becoming obvious after adjustments have already been made behind the scenes. Participants who depend on uninterrupted access are positioning accordingly, not by betting on price direction, but by minimizing exposure to uncertainty, a distinction that often gets lost in public discussion. That repositioning reduces the system's capacity to absorb shocks, even as it appears stable on the surface, creating a fragile calm that can persist longer than expected and then change abruptly. The recent highs may be interpreted as resistance or confirmation, but for those closest to the market, they function more like a diagnostic, revealing how much strain can be carried without forcing disclosure. If that strain continues to build, the question won't be whether silver has broken out, but whether the market has adapted fast enough to contain the consequences. At that point, the narrative will follow the movement, not lead it, and the window to act quietly will have already closed. For decades, silver's role has been defined by its ability to sit between categories without forcing decisions, neither fully monetary nor purely industrial, and that ambiguity has allowed pressures to accumulate without demanding resolution. What the recent highs suggest isn't a verdict on value, but a narrowing of options, as participants find it harder to defer choices that were once comfortably postponed. In the US, where markets are conditioned to believe that depth equals resilience, silver is testing a different proposition, that resilience depends on slack, and slack is no longer evenly distributed. If a breakout comes, it won't announce itself as a victory or a failure. It will arrive as a consequence, the result of overlapping decisions made in isolation, each rational on its own. The more important signal may be how quietly those decisions are being made and how little appetite there is to reverse them once conditions shift. Silver doesn't need enthusiasm to move, it only needs necessity, and necessity has a way of rewriting narratives after the fact. Whether this moment becomes a footnote or a fault line will depend less on price than on how much unseen tension the market can still absorb.